Hey everybody, Marty Mazur. Good morning, August 10th, 2018. Updating you this morning on our current correction chart. We began this discussion back in here when the market came down just over 10%, qualifying the move as a correction. And we've been kind of following it ever since and creating trend lines and so forth. Tested that low here, moved up, challenged this downward trend here, this trend line, tested it just a little bit there, and then we were kind of off to the races, establishing clearly a new uptrend. I told you in the beginning that the average duration of a 10+% correction since the beginning of the keeping of these kinds of records was 209 days. And I said, what are the odds of actually having it fall right in there, suggesting that they'd be very low. But if you look at my timeline here, we're just right on it, which would mean a couple of weeks or so, a week or two, we would actually, in theory, if we stayed on this timeline, we would actually end up at a new all-time high. I have expressed, or we have expressed a lot here on the blog, our concerns over the trade skirmishes. And I found an article quite interesting yesterday evening on CNBC's website. And I thought I'd just share with you an excerpt here. As hedge fund managers tried to preemptively calculate the effects of the trade dispute, the negative coverage made them bet against various stocks that they thought would be seriously debilitated as a result of tariffs. And it was Jim Cramer who made that comment. I couldn't agree more with the hedge fund managers in terms of their concerns over the ill effect of tariffs. He goes on to say that yet these benefits aren't paying off. The trade war just isn't producing the kinds of shortfalls that, in theory, should have kicked in this quarter, he said, citing the better than expected performance of stocks like Cummins and Emerson Electric. Turns out it's less of a problem than the doomsayers thought, which is why shorting's been such a bust, with the short sellers acting as a natural accelerant for the upside when they cover their stocks ever since the trade war with China first flared up 6 months ago. So again, I am in the hedge fund managers camp, although we're not shorting stocks, obviously, within client portfolios, and we haven't been getting overly defensive. But why not? If trade wars and protectionism is as bad as we here let on, why wouldn't we get defensive? And isn't it true that it's not so bad, given that the shorts have been so unsuccessful and lost so much money this year? No, actually, I don't agree. I don't think that Cramer really is expressing it the way we think it ought to be expressed. We think the market's doing okay, frankly, because general conditions are okay. And let me show you what I mean by that. Here is something that clients during reviews are no doubt familiar with. And I've shared this, I think, on the blog a few times here as well. Here's a 20-year chart of the S&P 500. These green and red numbers are the tests. If you go back more than a year, these are back tests of our proprietary index, which we use to track general conditions. It's 84 different data points, majority of them US economic statistics. There is what we call a financial stress subindex that we glean from the credit markets. And then just kind of the character of the equity market and the debt markets as well, bonds, and how they're trading. And we come up with this assessment of general conditions, and we score it every week. Up 100 would be the high, down or minus 100 would be the low. And you can see in here, using 2007, October as an example, the stock market was at an all-time high. But when we back tested our index, it was a negative 33, and that strongly suggests that probabilities favor a contraction or a recession slash bear market going forward. And you can see what we got. Here was the tech bubble bursting, stocks were near all-time highs, but things were rolling over in our index, suggesting that odds favor, no guarantees, but odds favored a contraction, which we got. In here, while people were still trading near all-time lows, or at not all-time lows, but certainly multi-year lows, you can see conditions began to improve. This would have been a good time to get cyclical again in your allocation, and you'd have done very well. Here, conditions really didn't improve till about 3 months after the bottom, and then the green was suggesting time to rotate back to growthy cyclical asset classes. So since then, as long as the index, and we have a lot of blanks to fill, by the way, we're actually in the process, it's a very slow process of going back and testing each week, and we'll actually have our own line graph to look at here at some point. But anyway, but as we tested in here at these key points, even here where it was getting low, it still suggested that odds favored an ongoing or a continuation of the then expansion and bull market. And here it got lower as well. Worst start to a year in history at the beginning of 2016, but general conditions were still good. So in my view, the reason the hedge funds have been so unsuccessful in their shorting campaigns is because general conditions remain strong. A plus 44, while it's quite a ways off from our yearly high, is still pretty strong and pretty robust. It's good breadth in that number, and suggests that shorts are playing a very dangerous game because they're going against general conditions. They would be making a lot of money if they were shorting the market here. If we had this tariff threat here, I suspect it would have exacerbated dramatically, like it did the Great Depression in the late 20s, early 30s, when they Smoot and Hawley convinced the president then to implement tariffs on thousands of goods coming into the country. It was a disaster. But conditions were such to allow it to be the catalyst for the worst market in history. I believe that's exactly where we'd be right now if conditions looked like this. Which brings me to our chart here. This is the actual life of the PW index since we've been scoring it on a weekly basis, so it's a little more than a year old. Here we actually had the all-time high, which is 82. I've been saying in the blog it was January 15th, but I forgot when I looked back at December 15th. We actually had an 82 on our index. So this is something that we need to pay attention to. We basically have deteriorated here in general conditions to the current 44, which is still very high. It's below zero. Below zero is where odds favor a contraction the way we read it. So we still are in good shape in terms of general conditions, but I don't like the trajectory. And if you look at where those stresses are coming from, I believe we can tie those largely to the threat of a protracted trade war and market responses, delay of expansion plans for businesses, concerns over inflation and the cost of tariffs and global supply chains and so forth. So I'll say it again. I do think that the hedge fund managers make good sense in terms of their concerns. Acting on those when general conditions are so good, unless you're doing it on a very short-term basis, can be a very dangerous, treacherous game to play. Today they're making money if they're short. As I speak, the Dow's down about 200 points. And while the situation this morning over Turkey, where you may be aware of some issues revolving Turkey and our relationships with them and their president's relationship with their economy, and some absolutely insane interventions that he's done on his own central bank and so forth. But this morning, due to our conflict that's pretty publicly known, the president has doubled the existing metal tariffs on Turkey. So I think maybe that exacerbated it some, but that was news right at the market open or just after the market open. The market was trading lower triple digits all night, or the Dow was, in the futures markets. This is traders, I think, concerned about a reaction to China and their reactionary or retaliatory tariffs that they imposed this week on $16 billion worth of U.S. cars and goods. Keep in mind, General Motors sells more cars in China during the year than they do the United States. So these are issues that we're concerned about. We make no bones about it. We don't think there's anything to gain in terms of the general economy, the consumer at large, and the aggregate of U.S. industries. And I think you know what I mean when I say that. There are going to be some winners, but the losers are the economy and the equity markets in the long run. If we allow this to take us to a place where our data says that conditions favor a recession or a contraction going forward. If we get down in here, we are going to have to really begin getting defensive within client portfolios. Because I don't think in here that exiting the trade war, while I think the market will get a boost, if general conditions have rolled over, I think that's going to have to play out, and we're going to have the next contraction and bear market before we are willing to get aggressive again or get cyclical again. But we're not in that realm right now. We're pretty safely above that zone. Incrementally, we are looking at rotating some money from consumer discretionary into consumer staples. We have some signals that tell us to do that. We're not in a hurry to do that. We don't think it's an emergency move, but we think over time we are going to be migrating to a more defensive position in some respects, but not all out defensiveness, because I'll say it again, we're not there just yet. Thank you, folks, as always, for watching and listening. Hope you have a wonderful weekend, and we'll talk to you again next week. Take care.